Good afternoon, and today I'll be presenting our report, How Does Non-Gaussian Return Distributions Affect Option Pricing Accuracy and Hedging Efficiency? This research investigates how modeling financial returns with non-Gaussian heavy-tailed distributions can improve option hedging strategies. Our report challenges the limitations of the Gaussian assumptions by introducing the Truncated Lévy Distribution, a model that captures extreme price movements while maintaining finite variance. By integrating the TLD into the Bouchaud-Sornette framework, we reformulate hedging as a variance-minimizing problem rather than a perfectly risk-free one. We analyze high-frequency S&P 500 data from 2023 July to January 2024. We evaluate how well each model replicates real-world behavior and how this impacts hedging efficiency and pricing positions. So what is the real motivation behind our report? Well, we have seen a growing convergence between financial econometrics and the niche field of econophysics. Traditional option pricing models, such as Black-Scholes, assume normal distributed returns and constant volatility. However, empirically, this is not the case. Econophysics provides a theoretical foundation to address these limitations by using tools from statistical mechanics, especially Lévy processes that we'll be using to model the heavy-tailed and scale invariant properties of market returns. This research builds on these insights to explore whether a truncated Lévy distribution combined with a GARCH volatility structure can better describe real financial dynamics and yield a more optimal hedge compared to Gaussian-based models. We will now discuss the contents of our Bouchaud and Sornette were among the first to extend the Black-Scholes framework by incorporating non-Gaussian stochastic processes. Their model redefined the option pricing problem by introducing fat-tailed distributions to account for extreme market events. Matenya and Stanley further developed the line of thought in Introduction to Econophysics, demonstrating how scaling laws and power law correlations govern market fluctuation. They even provided empirical evidence that financial returns exhibit self-similarity and heavy-tailed behavior. Finally, Klaus Pinn introduced the concept of minimal variance hedging under Schoenty distributed returns, a practical step towards capturing leptokurtic behavior in open markets. His findings showed that when the underlying distributions allow for heavier tails, hedging ratios must be adjusted substantially.
Now that we have introduced why Gaussian's assumption may fail in financial market, let's look at our empirical evidence. We analyzed about 4,630 million S&P 500 log return from July 2023 to February 2024. The average return is essentially zero, which is consistent with a weak form market efficiency. Looking at the log return time series, we observed volatility clustering, a long stretch of small fluctuation, followed by sudden bursts of large moves, especially at the end of 2023, October to December. This already deviate from the constant volatility assumption under the Gaussian mode. Turning to the distribution part, we clearly reject normality because the skewness is minus 0.12, meaning downside moves tend to the slight sharper, and the kurtosis is 8.29, far above the Gaussian's benchmark of 3. This indicates a sharp peak and a very heavy tail, so extremely return occurs more frequently. Visually, both the histogram and the KDE densities curves reinforce this. The distribution is fat tails and high kurtosis, no bell shape.
GBM is a simple model that describes how asset price evolve over time. It assumes returns are normally distributed and volatility stays constant. In other words, price moves smoothly with random fluctuations. This model is the foundation of the Black-Scholes option pricing framework. Looking at the result on the right, we can see the annualized drift and volatility are both quite small, which makes sense for the real market. However, the kurtosis value is around 8, which is higher than the normal benchmark. That means the real data has fat tails and extreme price move happens more often than what the GBM predicts. You can also see in the histogram, the top chart with real log returns is more peak and has heavier tails, while the simulated ones below look smooth and bell-shaped. So while the GBM captures general market trends, it misses volatility clustering and extreme events. We often see in real
So
data.
after seeing that the black Scholes struggle under the heavy tails and the volatility clustering, we move into the Bouchaud Sornette model, which is building for the real-world market. Instead of assuming we can hedge on away the risk like black Scholes model, this model trading hedging as a variance minimization problem. So rather than trying to eliminate all risk, it's aiming to minimize the portfolio variance. It's much more realistic in the market with the jump and the fat tails. The key innovation is the way this model handles volatility and the return. It's embed GARCH styles, consider volatility process, allow volatility to cluster and persist. And instead of assuming Gaussian shock, the model using truncated Lévy distribution. That means the return can exhibit heavy tails but still maintaining affinity variance.
So starting with the Gaussian distribution, the Gaussian distribution is a bell-shaped curve that assumes returns are normally distributed, meaning most movements are minimal and extreme movements are rare. Through our results, we obtain a mean of around 0 with a standard foot deviation of 0.134. The plotted history also shows a bell-shaped curve with a very sharp spike on the mean and the presence of fat tails, or what we call leptocritic, which indicates the Gaussian distribution estimates extreme values more than a perfect normal curve would be. So while the Gaussian distribution gives us a clean result, it tends to overestimate the frequency and magnitude of the returns and losers in the market. Next, we're moving on to the Lévy distribution. The Lévy distribution builds upon the Gaussian distributions by allowing heavy tails and more extreme movements, which is more realistically similar to the real financial markets. While Gaussian assumes thin tails and finite variance, the Lévy assumes that extreme movements occur more frequently. In our results, the stability parameter alpha is 1.999, showing that the distribution is symmetric but slightly heavier than the Gaussian. The scale is about 0.09, which also works like a standard deviation, which shows the spread of the data. From the data, we can also see that the Lévy curve fits the outer tails of the data more closely than the Gaussian, meaning that it captures extreme positives and negatives better. Overall, this shows that the Lévy distribution gives a more realistic and robust description of the financial returns. Next, moving on to the Truncated Lévy Distribution, or TLD. It is the refined version of the Lévy distribution by cutting off its Lévy distribution extreme tails, which results in the TLD having finite variance. In this model, the parameter alpha indicates how heavy the tails are. The smaller alpha indicates fatter tails and more extreme price changes. Our estimate alpha is 1.16, which still indicates quite heavy tail distribution. The parameter lambda determines the truncation, which is essentially how quickly the tail falls and decays to 0. A lambda 0.96 indicates that the tails are tempered but not completely cut off. So the model still allows for large, realistic market movements. And from the QQ plot, we can see that the TLD fits near perfect to the 45-degree
GBM model. We apply the Gaussian GARCH 1 model, which allowed volatility to change over time instead of staying constant. In this model, today's volatility depends on both recent market shocks and past volatility. As part of the model hypothesis test, our null hypothesis assumes that there's no volatility clustering, meaning past shocks don't affect current volatility. The alternative suggests that volatility clustering does exist. From the results, the parameter alpha 0.2 and beta 0.3 are both statistically significant, so we reject the null hypothesis. This confirms that volatility is time-dependent and persistent when large price movements occur. They are often followed by a higher uncertainty for a while. The model also showed an annualized volatility of around 2% and the kurtosis value of 14, indicating that returns have heavier tails than a normal distribution. In simple terms, this means extreme price changes occur more frequently than what a normal model like the GBM would predict. However, even though GARCH captures volatility clustering well, it still struggles to explain sudden jumps or crashes in price. To address this, we move beyond the Gaussian framework and integrate Sornette's approach using a Lévy distribution. This adds fat tails into the model, making it better at capturing rare extreme events and giving us a more realistic picture of the market risk, which leads into the next part of our analysis.
Now, building on the Gaussian GARCH model, our study extends it into the Lévy GARCH 1 framework to better capture the extreme behavior observed in financial returns. The key idea is that the volatility still involves through the GARCH process, so it remains of time varying, but the innovations are now drawn from a truncated Lévy distribution instead of a normal one. Mathematically, the conditional variance formula is as follows. The parameter alpha controls the tail thickness, and smaller alpha means the heavier tails, and the beta captures the asymmetry in its returns. This combination allows the model to reflect both volatility's clustering and extreme price jumps. Two stylized effects often missed by the Gaussian approaches. In other words, Lévy GARCH bridges the gap between the smooth volatility of Gaussian GARCH and the turbulent behavior of real-world markets. Using a high-frequency S&P 500 data, we found a strong volatility persistence, with alpha plus beta around 0.985, showing a long memory effect, and the estimated tail index alpha equals to 1.47, indicating heavily tailed returns, while the skewness beta of about 0.04 suggests nearly symmetry. At the 1% tail, the conditional value at risk break rate is 0.58%, close to the expected target, and the 5% tails also matches well. Overall, the Lévy GARCH model captures the tail risk and volatility clustering accurately, providing a realistic risk estimate during the market stress. These findings support using a Lévy framework within GARCH, leading to simulation on hedge performance.
Now moving on to our simulation section, this is where we tested our main hypothesis. The motivation behind our simulation was that traditional Gaussian-based models like the Black-Scholes often underestimate extreme market movements, but in reality, financial returns exhibit heavy tails and sudden price jumps, patterns that normal distributions simply cannot capture. To test this, we modeled a variance-minimizing hedge for an at-the-money European call option on the S&P 500 using high-frequency 30-minute return data from July 2023 to January 2024. We compared two models side by side. First, the Gaussian model, which assumes constant volatility and normally distributed returns, and second, the Truncated Lévy Distribution, which introduces heavy tails and an exponential cutoff that keeps variance finite. This allows for rare but realistic price jumps. The hedge ratio, denoted as phi star, represents the number of shares per hold per option to minimize portfolio variance. Mathematically, it's derived as phi star equals the value that minimizes the variance of the portfolio's wealth change. Or, in simpler terms, it's the optimal balance between the option and the underlying stock that smooths out risk. Using 20,000 simulated price tags, our results showed that the Gaussian hedge ratio was about 0.51, while the TLD ratio was 0.97. At first glance, the Gaussian model seems smoother with lower variance, but that's misleading as it ignores tails risk. The TLD hedge shows higher variance because it recognizes extreme price movements that actually happen in markets. When we look at tail risk metrics, the difference becomes more clear. The Gaussian model's conditional value at risk at 5% was minus 0.36, while the TLD was 0.37, showing that the TLD captures losses that the Gaussian model fails to predict. In practical terms, this means that TLD hedge is more adaptive to large shocks. It mimics how a real trader would adjust during periods of market turbulence. So overall, our simulation confirms the paper's hypothesis. Scaling-aware non-Gaussian models like the TLD better capture real-world hedging dynamics than the Gaussian-based Black-Scholes model.
In terms of limitations, there are a few key points to acknowledge. First, estimating Lévy stable parameters is complex and sensitive. Small changes in the tail index can significantly affect volatility and risk estimates. And unlike Gaussian case, there's no simple closed form solution. Second, the truncation parameters introduces identification issues. It's difficult to distinguish between a true tail cutoff and natural decay, especially with shorter data samples. Third, our dataset only covers 6 months of the 30-minute S&P 500 data, and this captures intraday volatility, but really not the full market cycles or structural shifts. Finally, the hedging results assume continuous and frictionless trading, so in reality, transaction costs and liquidity constraints would make implementations less precise. To conclude, this study set out to test whether hedging strategies based on a truncated Lévy distribution could better capture real-world market risk than the traditional Gaussian assumptions used in the Black-Scholes framework. Using high-frequency S&P 500 data, we found that returns display heavy tails, volatility clustering, and excess kurtosis. all of which contradict the idea of normally distributed returns. These characteristics justify the use of GARCH volatility models and highlights the limits of Gaussian approaches. While the Gaussian hedge produced lower variance, it systematically underestimates tail risk. In contrast, the Lévy-Garch model provided a more realistic depiction of extreme movements with hedge ratios adjusting more heavily during shocks. Overall, the results of the TLD framework offers a truer measure of risk exposure and superior hedging realism. Accurate tail modeling is therefore essential not only for hedging, but for risk management, option pricing, and stress testing in today's markets. Thank you.